Hi there, thanks for checking out my latest video. This video, as you probably know by now, is entitled Escape Hunts Roadmap to £1.50. They're currently priced at 21 pence, and it's a follow-up of a video I did recently talking about Escape Hunts Roadmap to £1. But since then, the digital side of the business is going gangbusters, and that's a bit of a game changer for them because it's low cost, high margins, globally scalable. Listen, if you like this video and you want the next one to your inbox, it's probably good to subscribe on YouTube by hitting that subscribe button and notification bell. But what's more important is I've got a newsletter, and I'm going to be sharing a special project with you if you are part of that newsletter. If you want to subscribe to the newsletter, then up there's an eye in the top corner there. All the way through the part of this video, there's an eye there. Just click on that, and it'll take you to my website, and just fill in your first name and email address. Okay, let's get into this video. Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Okay, this is it. The roadmap to 150, that's it. it doesn't, it's a bit more complex than that. But essentially, this is the roadmap. Okay? Current sites they have, physical sites is 15, soon to be 17, that's with Paris and Brussels, soon to be 18 with Milton Keynes. Short-term target. Now, that was a medium-term target. I didn't think they'd hit 20 until the end of this year. And now they're pretty much on 18, so they're going to smash 20 before the end of the year. Mid now, I'm saying, this was longer-term target, but mid-term target, I'm saying, is 50. Here we are at 21 pence a share, okay, 15 sites. Share price here, sites here, okay. X-axis sites, Y-axis share price. All right, and this is, I've just drawn this. I have knocked up, let's go in a spreadsheet here on the revenues and EBITDA as it getting better and better with each site, the market cap, and based on shares. I've broken it down to share price rather than market cap, so it's easy to see. So let's go back to that presentation. I'll show you. Okay. So let's start. So the acquisition, they mentioned this, and this was a cracking deal. 17.5 pence to raise 1.4 million. Okay, this is to do something, not just keep the lights on. It's actually expanding. Discount of 4%, 5-day average. Who does that? Which micro-cap company does that these days? There was no discount pretty much. The share price has risen quite strongly in the last 3 or 4 days, so there was a little bit more discount there, but only because the share price had risen, So literally, they did the fundraise, announced it on Friday. It dipped initially. People thought, oh no, placing. Private investors hated placing, and then they read the deal. And then the share price went up to 8%, and I think it ended the day up 5%. But how many times do you see, whenever I've seen that happen, a placing happen, and the share price goes up, it's been very, very bullish for the company. So you do, of course, get some sellers straight away, not like in the placing, so that drags it back a bit. But I think this is going to rally. The fundraise, relatively no discount, and that's unheard of. That's a little insight into the management here, okay? And that's a tip of the hat to them. And I'll show you more points towards the management, how they're quite sharp. So this is 1 time its average audited EBITDA for these sites. 1 times. It's a great deal of good management. They're taking advantage of the COVID here. And not many companies are. This is when they said, when you get recessions, there's always opportunity. If you're good management, a strong company, you can take advantage of a downturn. That's when the biggest plays are made. Because once everything starts rallying and we start recovering, it's too late then. It's going to be priced in. But right now they take advantage of these sites. So this will take them to 17 owner-operated sites, international expansion in Brussels and Paris. Of course, they've got franchisees elsewhere. They've got one in Dubai as well, owner-operated. So they are now expanding around UK and Europe. And of course, they've got franchises in Australia, America, so that. So this is the map. Look at this. 17 Brussels, 16 Paris. And they got Edinburgh, Leeds. And as I said, these are the current sites. 15, soon to be 17, 18, medium touch, 20. The one in Dubai as well out here. That's the sandy colour, desert. But all around, Birmingham, Cheltenham, Bristol. So, proposed acquisition, this is the number one. This takes them, 17, takes them to positive group EBITDA and positive cash generation. So some people asked me previously, why has the share price gone down this for like the last 2 or 3 years? And I've said to them, shares, it's not about looking backwards. If you're looking backwards, you're going to miss the game. If you're looking at the historical figures and you're not looking at what the company's doing or what they're going to do, you're going to miss the big moves. The reason why the share price went down, they came to the market with a bit of a hoopla because escape rooms were quite exciting and new. It's a new leisure sector. Leisure, they're very good businesses. If you get it right, leisure, you can earn lots of money in them. Like bowling or something like that, or cinemas. If you do well, this is a new exciting sector where investors can pile their money into. So they piled in, but they're never going to be profitable until 15, 16, 17 sites anyway. So there's going to be cash burn all the way down. Now they're at that inflection point where 17 starts to generate cash. That's real value. That's why share prices rise sustainably when a company is generating cash. Before that, when you're pre-revenue, a company's share price will pop and drop on news, on good news, with that news signifies the potential to earn good money in the future. But they're not there yet. And that's why you get more volatility in, say, resource stocks, which are nowhere near revenue generation or cash generation, but they go on news and they come up there. They're big pops. They can pop for like a couple of months or a day or a week, and we get big ones, but they'll come back down if they can't sustain that with real value generation, which is cash. Okay, and that's where Escape Hunt are. Site 17, they'll start generating cash, of course, after COVID. Okay, John Story, very sharp guy. I knew John basically got in contact with me after I did a Gfinity video. He was a big holder in that. Significant holder, 5-10% on that something, but he's in quite a few companies. John is coming on the podcast on Monday because he has wisdom, that I love talking to John. He's made a shed load of money in very sharp investments. He's got his own business as well. He's a very sharp guy. I thought I was doing quite well. I spoke to John. I think, God, he's like 10 times what I've done. But yeah, phenomenal. But he has taken, he already held 9.95% of Escape Hunt. Okay, now he's taken him and his company and related parties have taken another sort of close to £900,000 worth in the placing, and he's an NED. And he loves it, and he said he really likes the board. Directors increase skin in the game, so John has a lot of confidence here. And when people like John have confidence, it's worth paying attention. He's a sharp cookie not many people know about, and I'm hoping to introduce him to a wider audience, private investors, because I've got a sort of big private investor following, and he keeps his head on the radar and phenomenally successful. Okay, site 18, heads of terms signed for Milton Keynes, already on 18. In one RNS, they've jumped 3 sites. That's phenomenal. These are the only leisure company in the world, pretty much, expanding during COVID. That is good management again. Who else is expanding in the leisure sector? Most places are shutting sites down, laying people off. These are taking advantage. It's expanding. They raised money at the right time. They've raised a bit more money for this. They've still got cash around about 2.7 million. They're burning about 200 grand per month. That's 10 months worth of cash burn if they don't raise any more money, which they probably won't need to. And if lockdown still locks it down till 10 months, I can't see that happening. And digital is growing as well anyway. And paid home games are doing well. But I'm thinking lockdown will end March, and I'll show you a bit later why. And that's why you've got to, now is the time to don't worry about what's happened. It's what's happening, what's going to happen. Okay, that's where the stock market works. So look at this now. We've got this. I mean, look at how many sites there are already in the UK. And I talk about this. As this builds, as they get more sites, the brand becomes more familiar to people, It's like they become like a Pret or a Nando's, where people, before, when they first started off, or Hollywood Bowls and that, when they first started off, people didn't really know about them. Then you get this state where you have so many sites across the UK. The people say, let's go to escape hunt thing, and that becomes synonymous with escape rooms, and that plays into their business model. So Milton Keynes is the latest one, 18 there, okay, and Brussels and Paris here as well. So also they talk about here substantially stronger position. They think they'll be in a substantially stronger position to benefit from any recovery in demand post-COVID. Strong bounce back. So while I like this, it's a very big leverage play on the economy. Okay, the opening up, leisure stocks have been hammered, travel stocks. So it's good to get a bit of your portfolio into one of these recovery plays. And as a recovery plays goes, there's no better than this, because within that they've expanded their physical sites by 64% since lockdown. The digital games that didn't exist, pre-lockdown. They've come up with that, and it's going gangbusters. So now this company is like basically, a rubbish analogy here, but it's like a boxer, or a trainer, or someone, going. It's like the before and after. You've got someone in a relatively good shape as a person going to lockdown. Then they don't hear from them for like 6-7 months. And turns out they've been running 10 miles a day, pumping iron 4 hours a day, eating all the right foods. And they come out of lockdown, that's what it's like. And they're ready. We're stronger. We're better. We're faster. We've got more arms to business. This will bounce like a maniac. Honestly, I can't think of a stronger recovery play than Escape Hunt. They've come out stronger. There aren't any leisure companies that have done that. There aren't any leisure companies that have come out stronger from the lockdown than Escape Hunt. Escape Hunt is now a lot stronger. 64% stronger in the physical sites. They've got a digital arm to play at home arm they didn't have before. Phenomenal. I don't see how people can't see this. New products and markets. So significant progress has been made in the development of a range of digital play-at-home games products which did not exist before the first lockdown in March. So performance of these products has so far exceeded expectations, with revenue from remote play products exceeding 230 grand in 2020. High margins. Digital equals high margins. 230 grand may not sound like a lot. This was pretty much done in December. Last 2-3 months of the year when they've sort of finalised and got it ready, or last 3 months of the year, 230 grand, right? The margin on these, 80% gross. It's globally scalable. By the way, and this is what they can do. In one game, they did 342 players simultaneously. In one game, helping develop Escape Hunt business and Escape Hunt for brands B2B propositions. The kind of company that does this has 342 players playing a team-building game, are high-quality companies. They're the kind of companies you want as clients. They can exist anywhere in the world. They have massive teams, and they'll pay for this on a regular basis. Team building, fun games. It's all about ESG, environmental, social governance. The social part of it is, investing in your people. So the people that do, the companies that are actually paying for these games are well-heeled, deep-pocketed companies. 6,000 individuals in December, 200 corporates, scalable, massively scalable. And so that 230 grand adds close to 4 million pretty much to the value of Escape Hunt. Why? Because they're 80% gross margins, that's 184 EBITDA, times 20, because they're a fast-growing business. Not many people can do this. They're a global leader in this, okay? That's worth 3.6 million to them. And so if we scale that up, 250 grand in revenue from this digital games, it's worth 4 million. 500,000 is worth 8 million. 750 grand is worth 12 million. They do 1 million in revenue on digital, which I think they could do next year maybe. It's worth 16 million in value to the company. It's one of those things that another company would buy that company out for. It's an amazing weapon in your armory. If you do 2 million in revenue, of course, 32 million in value to the company. Very scalable, and they can do it very quickly. So that's what's exciting. That's why now I've done this video about £1.50. So they said investment in, this is a very interesting, I don't know if you spot this paragraph, investment in infrastructure, games masters to manage multiple games at the same time. So they've worked on software, right? They bought the software, and this was completed in the spring. So all the sites is now active, and all the sites open since then. So they can, that's very good, because of course they don't need lots and lots and lots and lots of people to manage the games. The games masters can manage multiple games at the same time. But this is interesting. Work has commenced on the discovery phase for a project to enhance the company's e-commerce capability. So that's also very interesting. But not only that, they've got other things going as well. Whilst a number of other projects to improve efficiency and improve scalability have been identified, which is good. See, good management again. The board intends to delay further work on these until COVID-19 are lifted. So they're preserving cash for now because, of course, there's uncertainty about when lockdown ends. I think it's to start ending on the March 1st. Or round about then, I'll show you in a bit why. So here we got site 17 now, right? 25 pence, and that's positive group EBITDA, positive cash generation. All right. Site 30, economies of scale, economy open by then, fully open. Economies of scale, having more favourable leases from landlords, commercial landlords who are suffering during this COVID pandemic. They're desperate. Some of these commercial landlords are getting like 20-30% rent. That's all they're getting at the moment. And because some people aren't paying, but a lot of companies are just leaving these high footfall premium sites, these shopping malls. And then, so they're desperate for landlords, and Escape Hunt are taking advantage of that, and they're being approached by these landlords. Modular designs have just come out with this, where they can be taken out of one site, put to another, so they can have lots of games, and they can vary games, they can transport them easier, they can sell them easier to franchisees, and they're a lot more affordable to create and transport around, efficient and scalable. And brand recognition, like I said, this is just with 16 sites in the UK. When they get to 30 sites, pretty much everyone will be within a half an hour drive of an escape hunt site, And when you are the premium brand, doing deals with Doctor Who, and you've got Doctor Who rooms and all that stuff, and Netflix, you want to do the best rather than some, slightly rubbish, independent one that's not been done very well down the road there, it was just one room. You want to go to the best and experience. If you're a night out, spend a bit of money, do the best. And I said, one of their rooms will be within driving distance of pretty much anywhere in the UK once they get to 30 sites. And that's what brand recognition is about. You go to your nearest shopping mall, there'll be one there. 37 sites. It's fast growth now. So as you saw previously, lockdown 66% or 60 increase in revenue, 55% like for like. This before the lockdown happened. So the growth is there. Just got to open back up and people will come. That's it. Digital contribution now is kicking in 8% growth margins here. This is £1.3, 37 sites, £1.3, broken the £1 barrier. What's that? Nearly another 5 times up from where we are at the moment. This lifts EBITDA to 200k. Okay, equivalent per site I'm doing times 20, 82 million market cap right there. And then we go to site 46. Increased international growth, institutional investment, of course, because the market cap's big enough. It's getting towards the momentum investors. When you get a company, a winning share price, money just flows into it. And it's a self-fueling. And all at once you can't stop momentum. Analysts can't price in momentum. I've seen stocks way overshoot some analyst target because it's been high growth. Everyone's piling into it. It's the next big winning stock. That's when the snowball effect happens. Doesn't stop. It's hard to stop it. Market cap there will be 121 million. All right. And there's 10 reasons why I think Escapement has excellent potential this year. Size, it's still only a 17 million market cap. That's all it is. After a massive, rally in the last few weeks, days, 17 million. That's nothing. Micro cap. Market leader, current size 18. Short-term target 20. Mid-term, it's short-term now. A couple of months it'll have 20. And so that builds. Mid-term 50. Sector, leisure will rebound strongly once hospital admissions start ticking down due to vaccines. I've talked about that. And of all the companies in leisure, this is probably the best placed. It's been growing. Name another leisure company growing during lockdown. They have been growing their potential to take advantage afterwards. Growth, like I said, 9 weeks to March 20th. Revenue from owner operated sites were over 65% compared to the same period in 2019. The physical sites, they say now 64% bigger than it was pre-COVID, 11 to 18. Locations, they acquired better prime location sites on cheaper terms, so the cost has gone down for them. Premium brand agreements with BBC Doctor Who game, Netflix in all homes. Digital, the digital is flying, it's low cost, high margin, globally scalable. Home play, played home games are performing well. Good management, the only leisure company doing great deals, launching new exciting products and physically expanding during lockdown. That's very impressive. Can you see why I'm enthusiastic about Escape Hunt? Honestly, it's just sit back and watch the guys do it. They're going to do it. That graph, it'll follow. So when does lockdown end? Because of course, it's a huge thing. Because even the digital side is growing, they also need the physical side because that's growing very quickly. And Boris recently said, once the 4 priority groups have been vaccinated by mid-February, we'll look at how they are doing. I want to look at this. So this is daily COVID-related hospital admissions, okay? At the moment, we're at 4,000 a day. Every hospital in the UK, this is. The coping levels start stressing above 3,000, okay? They start struggling. So that's a no-go. We should never go above that. We're never going to get anywhere near lockdown we give that. And I'd say even the peak here in sort of November gets a bit worrying. So we need to get down below the green, pretty much. And we're talking about less than 1,000 hospital admissions a day. The lockdown will not end until this is sorted, because this is the reason why we're locked down. This is the reason. All those idiots out there saying, why am I locked down? It won't bother me, because you can transmit it onto the vulnerable groups that will go into the hospital, take up a bed and paralyse our NHS. So then if anyone else needs treatment, cancer, accident, emergency, anyone, you won't get it. That is a serious problem with entire society. That's why your selfishness or not going to affect, we're saying, I don't care, I can't get it, will affect entire society. So until we get the hospital admissions down and NHS can cope, and it's funny because I'm not going to say doctor, but close doctor, because my son's got a lung condition. We got a close doctor, and she was saying very relaxed doctor, but she's very stressed at the moment, and she'd never seen anything like it, and I've never seen like that. So it's a real thing. So unless this comes down to about 1,000, we're not going to get the economy opened. But this is the stats: daily hospital admissions. Look, these are the age groups here. Okay. These are the percentages of thing. Now, 90%, this is 90% of over 65s are the ones being admitted to hospital. 9%. Below 64 years of age, only 9% have been admitted to hospitals. This is week ending 17th of January. Hasn't changed much. It's a point here or there. But 91% of COVID-related hospital admissions are above 65 years of age. That is the group that are filling up the hospital beds, and basically because of that, the rest of the NHS haven't struggled to cope. Luckily, so basically, if you look at the figures up here, 4,000 people, 3,600 of those admitted to hospital daily are above 65 years of age. 3,600. So only 400, are below 65 years of age. 3,600 is a phenomenal figure, isn't it? So, of course, it's age-related, but, like I said, we all have a part to play. Because we can stop elderly people being infected by doing social distancing and all that stuff. But look at this. Those are the people being vaccinated. So this group of people, I mentioned that here. This is the group of people currently being vaccinated, which is a good news. And right now, up until yesterday, 22nd of Jan, 5.8 million have been vaccinated in that group, which is very good. Now, if you look at that, look at the ONS sites, all this data from the ONS and by Public Health England, there are 12.1 million people above the age of 65 in the UK. Okay, that's above this age. So let's look how many have been vaccinated. So 12.1 minus that 5.8 there. These are the daily vaccinations. That's at 3,500. That's 6,000 left basically to do in that above 65 years of age. All right. At 350,000 doses a day, it will take 18 days to vaccinate the other 6.3 million. And we're doing, 478 yesterday. That was about 400,000. In fact, the last 3 days have been above, and this is growing, the number of outlets. I mean, there may be a problem with supply, they're saying, but I think I saw AstraZeneca saying they're quite very confident of supplying Britain with 2 million a week come Feb, or ramping up to by Feb. So it looks like, again, Pfizer's gone down a little bit, I know. But we could probably do that a week because we're now surpassing that. I think it'll do it again today because there's more. There's about 30 more sites opening this week. So we beat, this is the red line here, our doses needed to hit the target of 15 million that the government set out. I said last 2 days we've beaten that. And so that will go down, the average needed, because as long as we've beaten that, this average will come down. So that's the 11th of February when all these people needed to be vaccinated, these 12.1 million, okay? Add 2 weeks for immunity to build, so that is a kicking. And that's the 25th of February. But of course, half of these 12 million people will be done by Monday. That's 6 million, if we carry on as we are. So lockdown could end by the 1st of March, I'm saying, because by the time even the last batch of people in that, say the last 400,000 people, or last 350,000 people, sorry, in that batch of that priority group are vaccinated, most of them will have, it's a sliding scale. The immunity will be building in the people who've had it previously. So, but it takes 2 weeks. So even if the last batch of people get vaccinated on the 11th of February, then 14 days, 25th, they'll be immune pretty much, or to a high level, for 70% efficacy. So I'm saying give it another couple of weeks, 1st of March, and we should see a massive change. This is as long as the vaccine rollout carries on at current pace and is still effective of a new variant. So there's obviously always an if or but. But I'm thinking the 1st of March is pretty much close to a month away until the real economy starts opening back up. I don't think we're going back down then because, of course, they'll have second doses, then have more vulnerable groups coming in, and that will bring the hospital admissions down. That's what I'm thinking. That's what I'm hopeful for. All right. Final thought: if you rely, I saw this generic piece of sort of research done on, I think it was on Gfinity, and looking at the last 5 years of revenue. And they're basing the analysis on that. They had a website score on it. And I thought, they are so far off. They know nothing about the story whatsoever. They know nothing beyond like last 12 months ago, pretty much. And they're trying to form an analysis point of view, investment case on it. So basically, there's a tip. If you rely on an analyst's view or a website's scores when it comes to company research, you're going to miss out on the biggest movers. You have to do research. These views scores are based on historical trading data. Some back as far as 12 months. A lot can happen in 12 months, Ignore the most important part of investing. It's about the future. It's not about what a company has done. It's about what a company is going to do, okay? And that's why stock markets rally ahead of the real economy picking up, because that's pricing it into the future. It's all about the future. Ignore these sites that give, trailing reviews or scores. They're not going to help you find any winners. All they'll help you find is something that started doing well 3 years ago and is considering doing all changed. But I mean, if the company changed or management changed or the business model changed, it's not relevant, Thank you very much for watching the video. I hope that gives you some info to work on, to research. Don't forget that the share price has been quite hot at the moment. I always say buy on a down day, buy the dips. That's what I always think if you've done your research and you like your company. But this is not investment advice. And just one other thing, housekeeping kind of thing they say. But if you want the next video to your inbox. Oh, it's gone all dark. Hit that subscribe button, notification bell on YouTube. But if you want that and other things, then subscribe to my newsletter. Up there on the eye, click the eye there, and you'll see that you can go to my website and fill out your first name, email address, and you'll get my newsletter. Thanks very much for watching. Until next week.